Hey, it's Mark Ferguson with Investor More, and I'm back with another real estate video. Today, we're not just talking about real estate, but businesses. In fact, real estate versus businesses. What costs more, what makes more, the pros and cons to each. So I own quite a bit of real estate. I own commercial properties, large and small. I own multifamily properties. I have single family properties. I have my own personal house. We're standing in my real estate brokerage right now where I own this building. And I also own the real estate brokerage that rents this space from myself. And I've got other businesses like a laundromat, car wash, liquor store, mini mart. I have online businesses too. So there's pros and cons to both. They're valued very differently. They're bought very differently. They're sold very differently. I'm going to go over some of the pros and cons to why one might be better than the other. But just a quick preview, what's really interesting about businesses versus real estate is you might buy real estate for a cap rate, or it might be valued at a 6% cap rate, which means if you buy a property for $100,000, it'll make you $6,000 a year, or 6%. You might buy a business at a 30 cap, which means you buy a property for $100,000, is making you $30,000 in a year. So there's huge differences between the money they make. And you might say, oh my God, of course, businesses are better. Look how much more money you make. But you can also sell real estate for much more because of how it's valued. It's a real asset. It's easier to get loans on it. Whereas businesses are tougher to buy, tougher to leverage, tougher to sell. And there could be a lot of more management, a lot more work involved, a lot more hidden costs or things you aren't considering. And there's not quite as much of that in real estate. So there's a lot of different things going on between both of them. We'll look at these numbers, how they work, look at how much money you could make buying a business or real estate, and also what to look out for when buying businesses versus real estate. So the first thing I want to talk about is why there's such a huge difference in the valuations of real estate versus businesses. And it's pretty simple. With real estate, you have land, right? You've got land. I'm standing on land right now. You have utilities. When you develop land, you've got to put in electricity, water, sewer, septic, gas. Those can be very, very expensive. And getting those in is a massive, massive accomplishment, especially right now. That has value. And you normally have buildings, right? If you invest in real estate, you're typically investing in land with utilities and buildings. You could invest in just land, but usually you've got all three of these things. So I can buy a property. I own this building, a 68,000 square foot building with a grocery store, a restaurant, a dance studio, my office, and I could just run it into the ground, right? I could just force all my tenants out, just piss them off. They all leave, including myself and all my agents. And so what I'm left with is a building. I destroyed the business. I have no income coming in, but it still has value because I've got this nice building, or maybe it's not so nice in the future, but it still has value. This land, this parking lot, all the utilities that come with it, it has a tremendous amount of value, even if I destroy the business and run it into the ground. And that is why real estate is typically valued so much more than businesses, because you've got this hard asset that's almost always going to be worth something, no matter what you do to it. Even if I don't run it right, even if I ignore it for years and years and years. Now, it'd be really stupid to do that, but it's still worth something. Now with businesses, you've got inventory. So we talk about how much a business is valued based on its sales. Well, sometimes the inventory is added onto that. So if I'm, buying a business for $100,000 and it makes $30,000 a year in sales, if I've got $50,000 in inventory, I might be buying that inventory on top of that. I know it's a lot of weird numbers together that don't make much sense, but there is sometimes inventory added onto it. So that's kind of like a hard asset, but you can always sell it, right? It's not always going to be attached to the land or to the property. Employees are extremely valuable, the most valuable thing of almost any business, but they can leave, they can go away, or you can make them mad. Maybe you have patents with your business or product. Those can be sold too, or expire. You never know. A lot of businesses will lease their space. Even though I own this building, I still lease it because it just makes it work better for refinancing, for selling it for many different purposes. And that lease is not forever. That lease could expire. It could go away, or it could go up. And reputation, right? A lot of businesses are built on reputation, on previous actions, on the product they have. All of these things can be run into the ground and go away. I could buy a business, just destroy all of it, sell it, gut it, and you're left with nothing, absolutely nothing. Whereas on this side, you're left with the land, the buildings, utilities, in most cases. I mean, I suppose you could get hit with a meteorite. That's pretty unlikely, but it's possible. But over here, quite a few people are able to destroy businesses, run them into the ground, and you're left with nothing that makes no money whatsoever. So a lot of it is the risk on why they're valued so differently. There's just a much greater risk on this side over here. And it takes usually more work, even if you have managers, even if you have people running it for you, it takes more work to keep all this going and make this money and keep it coming in. Whereas this typically takes less work. You can manage properties, find tenants. It's not quite as labor intensive as that over there. And that's the main reason why businesses are usually valued much differently from properties. So you probably remember this from the very beginning of the video. And what this shows is real estate on one side and businesses on the other, cap rate versus earnings. So real estate is typically valued with a cap rate, at least income properties are. If you have multifamily, commercial properties, they're valued based on how much money they make. Single family properties are valued much differently. We're not really talking about these in this video. Some might be valued on a cap rate, but most are valued on what an owner-occupant will pay for them. So with real estate, like I mentioned, a 6 cap is pretty common, 7, 8%. So basically you're making $6,000 to $8,000 on a property per year that's worth $100,000. That's what that cap rate means. Or basically you're making you're paying 16.6 times the earnings in that range. Awesome if you're selling a property, but not as awesome if you're buying them because you're not making as much money based on how much you're paying for the property. As far as businesses goes, they're typically valued based on the earnings, how much profit a business makes. So you might have 3 to 4 times the earnings as a sales price or value for a business. So if a business is making $33,000 a year, it's worth about $100,000, maybe $120,000, depending on the industry it's in, the work that's involved, many different factors. But that's very common. You see with restaurants, laundromats, mini marts, gas stations, all kinds of businesses are typically valued in that range. And what that equates to is actually a 30 cap. So the larger the cap rate, the cheaper the property is based on its earnings. So it's crazy the differences here between real estate and businesses. But there's a reason for that. I mean, it's awesome if you're buying a business, right? You're making so much more money. This is awesome if you're selling it because you're selling it for so much more money. But this shows just a little bit of why I've been buying more businesses and less real estate, especially because real estate is really hard to make money on at a 6 cap. If you have leverage, if you have loans against it, most of your earnings are eaten up because this 6 cap does not count any leverage, any loans you have against the property. So if you're making $6,000 a year on a $100,000 property and your interest rate is 6%, well, it doesn't take a math whiz to figure out you just ate up all your profit and interest. So it's very hard to make money at a 6 cap. Now, when interest rates were lower, it was much easier, but there are ways to get good deals, add value, force appreciation, hope, prices go up or rates go down. You can still make money with real estate, but a lot of it is more of a long-term play, appreciation play, adding value play, getting a really good deal play. And right now it's really hard to actually make any money on it, especially if you have loans. Whereas with businesses, on the other hand, if you've got, $100,000 purchase price, and $30,000 coming a year in profit, you can have a loan on that. You can borrow money and still make money. Now, the trick with businesses is making sure that's a real number, right? And this isn't manipulated to make it look much higher than it really is, which happens all the time. But business owners also can shoot themselves in the foot by not reporting all their income. If it's a cash business, maybe they're pocketing a bunch of that cash, not reporting to the IRS, which actually can shoot themselves in the foot the other way around. And maybe they're actually making $60,000 a year, but they didn't report it, so they can't show it on their taxes. So there's all kinds of different things that go on with businesses. And it's really neat to kind of dive into this and figure out how they work and the numbers and everything. But it's definitely a lot different running a business, hiring people, figuring out all of this than just buying a property, finding a tenant, renting it. Completely different prospects there. Okay, so what are the things to watch out for on both of these? Now, there can be more risks with businesses. That's where they're valued differently. But with real estate, some of the risks you see are hidden costs. Maybe the insurance is going up a ton. The seller might not disclose all those things to you. So if they say it's a 6 cap, maybe it's really not a 6 cap. Maybe they're hiding a bunch of expenses and different things, and they're trying to cook the books. That can happen in both of these instances. Insurance could be going up. Who knows? Maybe there's claims against the property. You're in Florida where just rates are going up like crazy. The property all of a sudden is in a flood zone because FEMA changed the flood zones. There's issues there that can happen. Maintenance. Maybe there's a lot of maintenance going on with the property. The roof is bad and it constantly needs patched up and sealed, or the foundation isn't doing very well. It will need work soon. There could be water issues. There's all types of things that can happen with maintenance that should be disclosed on property, but they aren't always disclosed. But that could be an issue that's being hidden, not shown to you, and not in the calculations when they try and sell you this property based on a 6 cap or whatever it is. Property management. A lot of people don't mention property management. They say, oh, we managed it ourselves. Why would we mention property management? Because it took time. It took your time, took effort, took probably money to advertise it. Property management should be included in those costs as well. And then you've got some other issues that can come up too, like environmental issues. If you're buying commercial properties, you might need a phase 1 or phase 2 report saying, hey, this property doesn't have any issues. There's no gas tanks on it. There's no toxic chemicals or oil spills or things like that have happened on the property. Those can be extremely expensive to clean up, things to really watch out for. And of course, government issues. I've dealt with all of these. So I have a property now that is not in compliance with the government. It wasn't disclosed to me by the sellers, but it was a weird divorce situation, so it's hard for them to disclose it to me. I'm having to go through quite a few issues to bring this property up to what the government wants it to be. It was really hard for me to know that beforehand without going to the government and asking them all kinds of different questions and details. And so I could have done a little more due diligence, but these are definitely things that can come up. And sometimes government issues come up after you buy a property. Maybe Airbnbs are no longer legal in that area, or they change the zoning or something else. That can actually happen, and it can affect property. So those are things that can impact your property. You really want to be careful with, especially when buying something based on a certain value. And with businesses, some similar things, but bad or no books. I bought quite a few businesses that had no books, bad books, things weren't calculated. That can go, either way. It can make it worth more or less depending on how the books are bad. Maybe they aren't reporting all the income, which is good for somebody buying it, or maybe they're not reporting all the expenses, which is bad for someone buying it, trying to make it look better than it is. This can impact the value and the value of the business. Maybe the owner works in the business, right? They're not just hiring a manager. They're 8 hours a day, 5 days a week, maybe 7 days a week, working the counter, selling booze, right? That can happen. You need to know in your numbers, if you're not planning to be that person working in the store, right? How much money is that increasing to the bottom line? And what does the store actually make if you had to hire someone to do that job? Maybe that business pissed off a lot of people recently. That's why they're selling. Their sales looked great last year. But like, oh, we don't have our sales in this year. Maybe their sales tanked, right? We've seen that happen with a few companies, huge companies this year that would really decrease their value based on recent sales, but maybe last year's sales look amazing. So it's good to know, what the reputation is of that business. Check their social media, see if there's something going on. Lease issues, right? Maybe they have had a lease for 10 years in the same location, but now the owner told them, hey, after this next lease is up, I'm going to sell the property. I don't want you in here, or I'm going to use this property for my own use, or I'm going to move my son in here, and you've got to find a new space. That can be a huge issue for a business if it's been established and people know it's there, and now you've got to find a whole new place, move all your stuff, maybe even build out new stuff. That can really impact the value. And of course, government issues, licensing. Maybe a restaurant has had 2 strikes for IDing people and is about to lose their liquor license. That could happen. That could be a huge issue. Sales taxes haven't been paid. Liens against the business. There's all kinds of different things that can happen with this. Again, changes in laws. The liquor laws have changed in Colorado a few times, where now grocery stores can sell wine. That could impact a liquor store that's right next to a grocery store, right? So there's all kinds of things to consider, pros and cons, and you just kind of have to study these, figuring out what might impact business, what won't. if the books are good, if the numbers are good, and I always suggest people do your own numbers, like figure out what what the expenses are gonna be on your own based on what you think will happen, not what the seller tells you. Same thing with businesses, but it can be harder with businesses because you don't always know what those businesses are gonna do. And that can be tricky. But a lot of times, why would you buy a business? Why would you buy real estate? Well, you can get a good deal because of a lot of these things. A lot of times you can buy a business for much, much less than it would cost to start from scratch and build it out and buy the inventory and get everything up and running. Huge benefit to buying businesses instead of trying to start them on your own. Same thing with real estate, instead of trying to build something on your own, especially with these issues down here in the government restricting building and development in so many areas. This can, if you have these issues, a lot of times you can get really good deals, which are a reason to buy real estate, even when the returns aren't quite as high as they were. So there is some overview information on businesses versus real estate. It's hard to say which one I like better. I love real estate. I love the equity gain. I love leveraging, refinancing them. For businesses, I love the process of trying to figure out what sells, what doesn't sell, pricing. It's really fun for me. And they can make more money. But if you ever want to sell them, you're going to get a lot less for them based on what they make. So really, it's up to you, what you like to do, what you feel comfortable with. And if you can't decide, why not just go for both? That's what I've done a number of times. In a lot of my buildings, I own the business or operate the business within the real estate, which is also a great way to do both as well.